Billions vanished overnight. 2026, the crash begins. You felt the ground shift. But here's what the headlines won't tell you: this isn't just another correction. The pandemic didn't just impact the economy. It fractured it. Inflation didn't just rise, it mutated. And those cracks, they're still widening. But here's the part no one's talking about. The S&P 500, measured in gold, peaked in 2018. Not 2021. Not 2024. Star 2018 star. That's not a typo. That's a warning. Now, let's talk about 2026. The consensus isn't just bearish, it's preparing for collapse. Why? Because the numbers don't lie. But here's the kicker. Protecting your wealth isn't about keeping up with inflation anymore. It's about outpacing it, by margins most people can't even fathom. And that's the question you need to ask yourself right now. How did we get here? And more importantly, what happens when the storm finally hits? You think this is new? Think again. The 1970s didn't just have disco and bell-bottoms. They had stagflation, a toxic cocktail of sky-high inflation and stagnant growth. Oil shock after oil shock. Governments panicked. They slapped price controls on petrol. And what happened? The lines got longer. The shortages got worse. The problem they tried to fix, they made it worse. But here's the kicker, you're watching the same movie again. Since 2018, the US debt-driven expansion has been cooling. A slow-motion unwinding. A silent crisis. And no one noticed, because the markets were too busy partying. Then April 2026 hits. Jobs report stronger than expected. 9 straight days of wins. The Dow. The S&P. The Nasdaq. All dancing like it's 1999. But wait, it gets worse. While Google, GLD, and Amazon are printing money, the S&P 500 and Dow Jones, they're whispering instability. This isn't harmony. This is a market screaming in 2 different voices. And you need to hear both. So what's the play? You can't fix a debt problem with more debt. You can't cure inflation with wishful thinking. And you sure as hell can't ignore the past when it's knocking on your door. But here's where things take a dark turn. What does this sector surge, even as the broader market wobbles, really mean for you? Stay with me. Because the answer isn't just in the numbers. It's in the shadows. You've seen the charts. You've felt the tremors. But what if I told you this isn't new? My name is Lydon the Stater. My lineage stretches back to the first empire to mint true coinage, Lydia, 600 BC. We didn't just create money. We survived its collapse. Not once. Not twice. 3 times. The Lydians watched empires crumble. They saw currencies devalued overnight. They endured shocks that make 2026's volatility look like a gentle breeze. But here's the difference, they had a strategy star. And that strategy wasn't luck. It was wisdom. Wisdom forged in fire. Wisdom that outlasted kings, wars, and entire civilizations. This channel isn't about predictions. It's about patterns. The same patterns that dictated wealth in 500 BC still dictate it today. But here's the question no one's asking. How do these ancient lessons translate into the very real, very modern threat of the S&P 500's potential breakdown in 2026? Stay with me. The answer will redefine how you invest. You remember the 1970s, right? Gas lines. Inflation. A market that refused to behave. But here's what you don't remember, because it hasn't happened yet. The S&P 500 in 2026 could be staring down the same barrel. Not because of disco. Not because of bell bottoms. But because of something far more dangerous, a perfect storm of corporate earnings collapse and recession. And today, we're dissecting it, data point by data point. Let's start with the numbers. April 2023. The jobs report drops. Stronger than expected. The Dow, S&P 500, Nasdaq, all surge. 9 straight days of gains. But here's the catch, those are lagging indicators. They tell you what already happened. Not what's coming. And what's coming? A reckoning. Because beneath the surface, the pressure is building. Inflation isn't just high, it's sticky. Corporate costs are rising. Wages. Shipping. Raw materials. And when costs go up, but prices can't keep pace, profit margins get squeezed. And profit margins are the lifeblood of the stock market. But here's where it gets worse. Consumers. They're feeling it. Every time they fill up their tank, every time they check their grocery receipt. And when consumers pull back, demand drops. Suddenly, companies aren't just dealing with higher costs, they're dealing with lower sales. And that's the recipe for an earnings contraction. Let me put this in perspective. In 2022, S&P 500 earnings grew by 5.4%. In 2023, that growth slowed to 1.2%. And in 2024, analysts are already slashing estimates. But here's the kicker, those estimates assume no recession. And that's a bet I wouldn't take. Because this isn't just a US problem. It's global. The pandemic didn't just disrupt supply chains, it broke them. And they're still broken. Add in geopolitical tensions, Ukraine, Taiwan, the Middle East, and you've got a powder keg. One spark, and the whole system could ignite. Now, let's talk about the consumer. Because they're the ones holding this whole thing together. Or not. In 2021, confidence was high. People were spending. Stimulus checks. Pent-up demand. But by 2023, that confidence had cratered. And in 2024, it's still falling. Why? Because inflation isn't just a number, it's a tax. A tax on every single purchase. And when that tax gets too high, people stop spending. And when people stop spending, companies stop hiring. Then they start firing. And when unemployment rises, the cycle feeds itself. Less spending. Lower earnings. Lower stock prices. It's a death spiral. And in 2026, we could be staring right into it. But here's the part nobody's talking about. The S&P 500 isn't just vulnerable to a recession. It's vulnerable to stagflation. That toxic mix of high inflation and high unemployment. The same thing that crippled the 1970s. And if you think it can't happen again, think harder. Because the conditions are already aligning. Let's break it down. In the 1970s, oil shocks sent prices skyrocketing. Today, we've got energy crises, supply chain shocks, and a Fed that's way behind the curve. In the 70s, the Fed waited too long to hike rates. Sound familiar? Because in 2021, they called inflation transitory. And by the time they acted, It was too late. And here's the kicker, when the Fed finally does act, they overcorrect. They hike rates too fast, too hard. And that's what triggers the recession. The yield curve inverted in 2022. Historically, that's a 98% chance of recession within 24 months. And if that recession hits in 2024 or 2025, the S&P 500 could be looking at a 30% drawdown. Or worse. But here's where things take a dark turn. Because even if the recession doesn't hit, the earnings contraction could be enough to sink the market. Let's look at the numbers. In 2021, S&P 500 companies posted record profits, $1.8 trillion. But by 2023, those profits had already started to shrink. And in 2024, analysts are forecasting a decline. Not just slower growth. A decline. And when earnings decline, valuations get crushed. Because the stock market isn't just a bet on the future, it's a bet on earnings. And if those earnings are falling, the market follows. Now, I know what you're thinking. Lydon, this is all doom and gloom. What about the companies that will survive? And you're right, some will. The ones with pricing power. The ones with strong balance sheets. The ones that can pass costs on to consumers. But here's the problem, those companies are the exception, not the rule. And even the strong companies aren't immune. Because when the market crashes, it doesn't discriminate. It takes the good with the bad. And in 2026, the bad could outweigh the good. So here's the question. If the S&P 500 is staring down the barrel of a recession, a profit contraction, and a potential stagflation crisis, what do you do? Do you panic? Do you sell? Or do you prepare? Because here's the thing, crises don't announce themselves. They creep in. They start with a whisper. A slowing jobs report. A dip in consumer confidence. A yield curve inversion. And by the time you hear the scream, it's too late. But here's what you can do. You can watch the data. You can track the leading indicators. And you can position yourself before the storm hits. Because the difference between a crash and an opportunity, it's not luck. It's preparation. And that's what we're doing here. We're not just talking about the problem. We're dissecting it. Because the S&P 500 in 2026 isn't just a number. It's a warning. And if you listen closely, you'll hear it. But here's the part that should keep you up at night. The 1970s didn't just have stagflation. They had something else. Something that made the crisis even worse. Price controls. And if you think that can't happen again, you're not paying attention. Because the ghost of those controls, it's still haunting us. And in 2026, it could come back to life. Close your eyes. It's 1973. The air smells like fresh cut grass and possibility. This family, let's call them the Carters, has done everything right. Dad works at the factory. Mom teaches part-time. They've saved $10,000. That's enough for a down payment on a house, a college fund, a safety net. They believe in the dream. But here's what they don't know yet. The world is about to break. The oil shock hits. Overnight, petrol prices double. Governments panic. They impose price controls, no more than 50 cents a gallon, they say. But the math doesn't work. Suppliers can't afford to sell at a loss. So they stop. Now, the Carters can't fill their tank. Not because they don't have money, because there's no gas to buy. They wait in line for hours. Sometimes, they leave empty-handed. But it gets worse. Inflation doesn't stop. It gnaws at their savings like a rat in the walls. That $10,000. By 1980, it buys what $5,000 did in 1973. Their dream home, now out of reach. Their kids' college fund, halved. And the jobs. Factories slow down. Unemployment climbs. The Carters aren't lazy. They aren't reckless. They're just trapped. Now, imagine being the kid in that family. You don't understand the economics. You just know your dad comes home angry. Your mom cries in the kitchen. The future you were promised. It's slipping away. I've met people who lived this. A man in Ohio told me, "I watched my father's hands shake when the bank statement came. That's when I learned money isn't just numbers. It's security. It's dignity." This wasn't a recession. This was a decade of erosion. Of watching your life's work dissolve, year after year, while the people in charge told you it was all under control. So why am I telling you this? Because the ghost of the 1970s isn't just a history lesson. It's a warning. The oil shocks. The price controls. The stagflation. It all happened before. And it can happen again. But here's the question that keeps me up at night. Are we repeating the same mistakes? With tariffs choking supply chains. With national debt spiraling. With inflation still lurking in the shadows. The Carters didn't see it coming. Neither did their government. Will we? You remember the 1970s. Gas lines. Inflation. A market that refused to behave. But here's the question no one's asking in 2026, are we repeating the same mistakes? Not with oil this time. With something far more insidious. The Trump tariffs. You thought they ended in 2020. They didn't. The shadow lingers. In 2023 alone, those tariffs cost American consumers $57 billion. That's not a typo. $57 billion. And here's the kicker, tariffs don't just raise prices. They strangle trade. Look at this. Trade volume between the US and China dropped 19% after the tariffs. 19%. But here's where it gets worse. Those tariffs didn't just hurt China. They hurt US manufacturers too. Why? Because supply chains don't care about politics. They care about cost. And when costs rise, earnings fall. In 2024, 62% of S&P 500 companies reported lower margins due to tariff-related supply chain disruptions. 62%. That's not a blip. That's a trend. And trends become crises. But tariffs are only half the story. The other half? Debt. In 2018, U.S. national debt was $21 trillion. Today, $34 trillion. That's not growth. That's a runaway train. And here's the part no one talks about, interest. In 2025, the U.S. spent $1.1 trillion just on interest payments. $1.1 trillion. That's more than the entire defense budget. But here's the real kicker, when interest rates rise, that number doesn't just grow. It explodes. Neil Ferguson put it best. Finance is the foundation of human progress. But what happens when that foundation is built on debt? What happens when the bills come due? Here's the connection you're missing. Tariffs shrink trade. Shrinking trade slows growth. Slow growth makes debt harder to manage. And unmanageable debt. That's how empires crumble. In 2026, the S&P 500 isn't just fighting inflation. It's fighting a two-front war, tariffs and debt. And here's the thing, markets hate uncertainty. But uncertainty is all we've got. So ask yourself, if the foundation is this unstable, what's the safe haven? Gold? Bonds? Bitcoin? But here's the loop I'm leaving you with. Can a relic like gold truly offer the protection it once did, or is its reputation just a historical myth? You want the truth about gold? Let's settle this now. Because the debate isn't just academic, it's about whether your wealth survives the next storm. Back in 1973, gold was $97 an ounce. Today, over $2,300. But here's the kicker, while the dollar lost 85% of its purchasing power, gold didn't just keep up. It dominated. The S&P peaked in gold back in 2018. That's not a typo. That's a warning. Critics call it a barbarous relic. But central banks bought 136 tons in 2023 alone. That's not nostalgia, that's strategy. But here's where the debate gets ugly. Gold pays no yield. No dividends. No rent. So why are the smartest players loading up? Because in 2024, explorers staked 24 new gold claims in Nevada, one with grades of 837 grams per ton. That's not a mine. That's a gold rush. Wait, if gold is so powerful, why isn't everyone rich? Because most people treat it like a lottery ticket. They buy high, panic sell low, and blame the metal. Here's the truth no one tells you, gold isn't about getting rich. It's about not getting poor. For 5,000 years, it's been the ultimate insurance policy. When currencies collapse, when markets freeze, when trust evaporates, gold doesn't ask permission. It just is. But here's the dark twist. Gold alone won't save you in 2026. Not if you're relying on a single asset. The real question isn't whether gold works. It's how much you need to survive what's coming. And that's the part no one's talking about, until now. Because if gold isn't the sole answer, what combination of ancient wisdom and modern strategy can genuinely safeguard your wealth from the coming market shift? Stay with me. The answer will redefine how you protect everything. You remember the question I left hanging last time. If gold isn't the sole answer, and it isn't, then what is the combination that can genuinely safeguard your wealth from the coming market shift? The Lydians didn't just survive. They thrived through empire collapses, currency debasements, and wars. Not because they had a magic metal, but because they built something far more powerful, diversified resilience. And here's the thing, their strategy wasn't about finding a single, perfect asset. It was about constructing a multi-layered defense. A fortress, if you will. One that could withstand storms from any direction. So let's walk through these layers. One by one. Because this isn't theory. It's history. And it's about to become your playbook. First, the principle of real-time value. The Lydians didn't wait for quarterly reports. They watched the markets daily. They understood that wealth isn't static. It's dynamic. It flows. And if you don't see the currents, you'll drown in them. Now, in 2026, you have a tool they never did. A real-time barometer of global economic health. Brent crude oil. You're seeing it right now. $87.42 per barrel. That number isn't just for traders. It's a pulse. A heartbeat. When Brent spikes, inflation isn't far behind. When it crashes, demand is collapsing. And in 2026, with geopolitical tensions simmering and supply chains still fragile, this number is your early warning system. But here's what most people miss. The Lydians didn't just watch prices. They acted on them. When grain prices rose, they stored it. When silver flooded the market, they bought it cheap. They were ready. Therefore, the first layer of your fortress: awareness. Not fear. Not panic. Awareness. And in 2026, that means checking Brent crude every morning. Not for trading. For survival. Now, the second layer. Hard asset hegemony. Yes, gold is part of this. But it's not the whole story. The Lydians didn't just hoard gold. They owned land. They controlled trade routes. They minted coins. They built infrastructure. They understood something critical: intrinsic value. In 2026, this translates to a strategic allocation across hard assets. Gold, yes, but also real estate. Not just any real estate. Income-producing real estate. Properties that generate cash flow even when markets dip. And commodities. Not for speculation. For stability. Think agricultural land. Think energy. Think the things people will always need. But here's the key. The Lydians didn't put all their wealth into one asset class. They diversified within hard assets. Because they knew, a fortress with only one wall is no fortress at all. Therefore, your second layer isn't just about owning gold. It's about owning real things. Things that can't be inflated away. Things that hold value when paper money doesn't. Now, the third layer. And this is where most modern investors get it wrong. Income flow fortification. The Lydians didn't just store wealth. They grew it. They built systems. Trade networks. Tax structures. They created flows of income that didn't depend on a single ruler or a single market. In 2026, this means building passive income streams that are uncorrelated with the stock market. Dividend growth stocks. Not the flashy tech darlings. The steady, reliable companies that increase their payouts year after year. Think consumer staples. Think utilities. Think the companies that sell the things people can't live without. But it's not just stocks. It's real estate income. Royalty streams. Even structured notes. The goal? Cash flow that keeps coming even when capital values are under pressure. Because in a downturn, cash flow is oxygen. And most investors, they're suffocating. Therefore, your third layer isn't about growth. It's about survival. It's about having income when others are forced to sell. And now, the final layer. The one that separates the wealthy from the truly resilient. Strategic liquidity. The Lydians always kept a portion of their wealth in liquid form. Not because they were afraid, but because they were ready. Ready to acquire. Ready to lend. Ready to act when others were paralyzed. In 2026, this means holding a prudent amount of cash. Not under your mattress. In short-term, highly liquid instruments. Treasury bills. Money market funds. Things that are safe, stable, and immediately accessible. But here's the counterintuitive truth. Most people think cash is wasted in a high-inflation environment. The Lydians knew better. They knew that cash isn't about earning. It's about opportunity. It's about being able to buy assets at fire sale prices when everyone else is desperate. Therefore, your fourth layer isn't about fear. It's about power. The power to act when others can't. Now, let's bring this all together. Because this isn't just a list. It's a system. The Lydians didn't just survive 3 empire collapses by accident. They did it by design. By building a system that could adapt. That could withstand shocks. That could thrive in chaos. And here's the thing, this system isn't just for kings. It's for you. Because in 2026, with markets more volatile than ever, with geopolitical risks rising, with inflation still lurking, you need a fortress. Not a single wall. Not a single asset. A system. But here's where things get interesting. Because as we bring these threads together, we're about to see something remarkable. How the Lydian principle of diversified resilience doesn't just protect your wealth, it positions you to profit from the very crises that destroy others. And that's the blueprint. The one I'll show you in full, but only if you stay with me. Because this isn't just about surviving 2026. It's about dominating it. You've seen the shadows. The 1970s weren't just a decade of disco and bell-bottoms, they were a warning. Stagflation gutted savings while the world watched. But here's what they didn't tell you, that pain wasn't random. It was the sound of an empire stretching too thin. Fast forward to 2018. The S&P 500, measured in gold, hit its highest point in history. And then, it began to fall. Not because of a crash, but because the foundation was rotten. Now, in 2026, we stand at another crossroads. Tariffs choking trade. Debt strangling growth. A market teetering on the edge of revaluation. You've heard the pieces. But until now, no one's shown you how they fit together. This is where the Lydians rise from history. They didn't just survive empires, they thrived through them. Their secret? Diversified resilience. Not just owning assets, but understanding their purpose. Gold for preservation. Land for stability. Trade for growth. Each wall of their fortress held a different weight, because wealth isn't a single number. It's your future. Your freedom. And here's the truth no broker will tell you, the system wants you to chase returns. But the Lydians? They built for survival. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. But if you're here, you already know the stakes. The question isn't if the storm comes, it's whether your fortress will stand. And the Lydians understood something even deeper. A final principle so counterintuitive, modern finance trains you to ignore it. What is it? That's the key I'll reveal at the end. Stay with me. You remember the question I left hanging. If gold isn't the sole answer, and it isn't, then what is the combination that can genuinely safeguard your wealth from the coming market shift? The Lydians didn't just mint the first coins. They didn't just trade. They mastered something far more powerful, something modern finance actively trains you to ignore. Here's the truth no algorithm will tell you, wealth that lasts isn't built on abundance. It's built on scarcity. Not scarcity of desire, but scarcity of supply. The Lydians understood that true capital isn't just what you own. It's what you own that cannot be replicated by decree, duplicated by code, or inflated by policy. While today's financial system pushes you toward digital assets, debt instruments, and endlessly reproducible tokens, the Lydians taught something radical: your wealth must be tethered to something fundamentally limited. Think about it. Gold, land, rare earth metals, even certain forms of intellectual property, like a patent on a life-saving drug or a copyright on a timeless work of art. These aren't just assets. They're counter-cyclical fortresses. When the broader fiat system falters, when inflation spikes, when currencies devalue, when markets crash, scarcity-backed capital doesn't just hold value. It appreciates. That's not coincidence. That's physics. This coin isn't just metal. It's a message. A message from 2,600 years ago that says, the less of something there is, the more it's worth, and in 2026, with central banks printing trillions, with digital currencies flooding the market, with debt levels at all-time highs, that message isn't just relevant. It's urgent. But here's where most people get it wrong. They think scarcity-backed capital is just about hoarding gold. It's not. It's about strategic cultivation. It's about actively seeking and holding capital that is inherently resistant to manipulation. Gold is one example. Prime agricultural land is another. Rare collectibles, like first edition books or vintage wines, can be another. Even certain types of private equity in niche, non-replicable industries fit the bill. The principle is the same: if it can't be printed, it can't be debased, and in a world where 87% of global money supply is digital, created with a keystroke, that principle is your shield. The Lydians didn't just survive. They thrived. Across empires. Across centuries. Across collapses. And they did it by anchoring their wealth to what could not be replicated. Now, I need to be clear. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. But if you take one thing from this, one principle to carry into 2026 and beyond, let it be this: the future belongs to those who control the scarce. The markets may crash. Currencies may fail. Governments may print. But scarcity-backed capital, it doesn't just endure. It prevails. And that is the ultimate Lydian secret. But the 1970s warning wasn't the end of the lesson. It was just one layer of the fortress you must build. To arm yourself with the knowledge needed to navigate what's coming, you must stay ahead. Click the bell, now. My next broadcast reveals which industries will collapse first in the downturn, and where the hidden opportunities lie. Your financial future demands foresight. Stay vigilant. Stay wise. Remember, the greatest wealth isn't what you accumulate. It's what you protect. Next, we'll uncover the exact ratio King Croesus used to survive 3 empire collapses.